Exclusive now with Chevron's chairman and CEO, Mike Wirth. Mike, it's always good to see you, and in person as well, for the first time in a while.
It's nice to be here in person.
It's a good morning to have you. I'd love to just start off on the commodity itself, that at least being oil. Up again, kind of holding in there in the low, mid-80s. Are you surprised at all by the move that's taken place over these last few months?
Well, you have to step back and think about how oil prices are set. They're set in a global market. Typically, supply and demand are both big numbers, about 100 million barrels a day, and they move slowly. And so any differences tend to go into or out of storage, and markets are relatively stable. What we saw a year ago is demand collapsed. Supply can't adjust that fast, and so tanks filled up to a point where prices actually went negative.
Right. They went negative for a period of time there, of course. That was the spring of 2020, something we've never seen.
They were very low for a long period of time, and producers adjust. They cut production, they cut capital spending.
Yep.
Now we're seeing demand come back strongly in, frankly, every sector of the economy except international air travel. And we still see supply responding more slowly. So I think the market's concerned that that supply won't necessarily keep up with the strength we're seeing in demand. And I think that results in this view that there needs to be a stronger price.
This will hang in there. Well, one of the themes we've discussed many mornings, of course, Jim and Carl and I, is the fact that many producers don't seem intent on putting a lot more money into development right now as they do returning it to shareholders, allocating capital instead to buybacks and or even dividends as opposed to spending. Is that appropriate for this environment?
Well, I think there's a couple of things that have changed that really do affect the rate of reinvestment. One is government policy, and we certainly see policies that have discouraged future fossil fuel development. And then we also have seen messaging from investors that they prefer a return of cash. Certainly in the exploration and production sector for a number of years, most of the cash generated seemed to go back into growing production, and investors want to see a return on their cash. But we've also seen at annual meetings this year, investors vote for proposals that would actually limit future production. So there are a number of things that are impeding what I think would be the normal reinvestment behavior on behalf of producers around the world. And I think it's another thing that the market is concerned about.
Yeah, well, you mentioned annual meetings. I mean, there's a backdrop here of escalating external demands in terms of ESG. You've been responding to that. But you also lost a vote, right, to address Scope 3 emissions at your 21 annual meeting. How did that change, if at all, your approach?
Well, we've been working on responding to the concerns about climate for many years. We've set targets. We've met and exceeded targets to reduce emissions associated with our operations. And just last week, we announced a new target to include all emissions, whether it's from the production and manufacturing and transportation of our fuels or the use of our fuels, so wrapping everything together, setting a target to reduce that. We've also recently announced a tripling of our capital spending to invest in new technologies, particularly in sectors of the economy that are difficult to electrify. So this is things like aviation, marine transportation, heavy-duty on-road transport, manufacturing. We want to help develop the solutions for customers in those segments to help them meet their low-carbon goals.
Yeah, spending as much as $10 billion through 28. At the same time, though, Michael, I'm looking at a research report from B of A that was just out last week. They say you're navigating a fine line that increases green investments, but at a scale that does not materially impact a fundamental strategy focused on enhancing a portfolio already anchored on some of the lowest carbon intensity projects in the industry. Is that a fair characterization, that you're navigating a fine line?
Well, it's a challenging world out there. I think everybody's trying to find a way to help respond to the concerns about climate and at the same time meet the energy demands of the world as it is today. And certainly in a number of different parts of the world today, in Europe, in China, we're seeing the strains on the system to meet the needs of the economy as it is today, even as we're investing for a cleaner energy system in the future. So there's a tension there. And we're
not hearing enough about transition? I mean, we're starting to. But this idea that we can't just go from one to the other, so to speak, in a period of time that would seem to be at least the expectations of many investors and or people in government.
Well, I think you bring up a really important point. This will take time and it will take massive investment. And we have a global economy that's dependent upon reliable, affordable energy supply every day. And when there are disruptions to that energy supply from a storm, from some other kind of an event, we see pretty quickly how dependent the world is on today's energy supplies. And so we need to navigate an orderly transition that doesn't put economies, consumers, societies at risk or create concerns about the security of their energy supplies. Or I fear we could see some, loss of some of the support for this transition. That.
All right. We mentioned, of course, your significant increase in terms of spending on these initiatives, as much as $10 billion from what had been, I think, $3 billion originally. Is there a scenario under which you would consider increasing them even more? Is the possibility of a tax on carbon, for example, something that might motivate you to say, you know what, we can allocate even more capital?
Sure, absolutely. Look, there are really four big drivers, David, that will govern how rapidly this proceeds. One is policy, so a tax on carbon. One is technology. How quickly can we bring the cost down in some of these technologies? Innovation. How do we integrate technologies in new ways that we haven't before to meet these demands? And then the fourth one is markets and the signals from equity markets, from commodity markets, that are the things that really mobilize capital in the marketplace. And we need to mobilize massive amounts of capital if we're going to restructure the energy system. So all of those are really important factors.